Bonds are IOUs. The buyer of the bond is the lender. The issuer of the bond is the borrower. There are two types of bonds, the conventional bond and the zero coupon bond. If you were to purchase a conventional bond, you would pay the issuer the full face value of the bond, in this case, $100. While you are holding the bond, the issuer would pay you periodic interest payments, usually quarterly or semi-annually. The amount of the payment would be based upon the bond's coupon rate, in this case, 4.5%. So the annual interest payment would be $4.50. Upon the maturity date, the buyer could redeem the bond for the full face value. The term coupon stems from the fact that the bonds used to come with coupons. The investor could clip the coupon from the bond on a specified date and send it in to the issuer, and the issuer would send the bondholder the interest payment. But since records and information are now kept by computer, bonds no longer need coupons. In fact, most bonds aren't even printed out on paper. The zero coupon bond does not make periodic interest payments. Instead, the buyer of the zero coupon bond buys the bond at a discount from its face value. Then, on the maturity date, the buyer redeems the bond for its full face value. Rather than receiving periodic interest income, the interest income to a zero coupon bond is the difference between the purchase price and the face value. For that reason, zero coupon bonds are sometimes called discount bonds. Let me start with the zero coupon bonds, because with zeros, it's much easier to see the inverse relationship that exists between bond prices and interest yields. Pause the video and check out these examples right here. In each case, the maturity value and maturity date are the same, and the only thing that varies from example to example is the purchase or auction price. And what you will see is that if the purchase price is higher, the interest yield is lower, and vice versa. These simple little problems did not require the use of the time value of money formulas, because in each case the time till maturity was 1 year. However, when there's more than 1 year till maturity, we need to use the time value of money to compute the interest yield. Check out this example. The future value is the maturity value of the bond, and the present value is the purchase price of the bond. And in this case, the bond matures in 5 years. You can use this little present value formula here to determine that this bond will pay about 4.5% per year. Here are some examples of some zero coupon bonds. This first is a double E series savings bond issued by the federal government. Here's a municipal bond issued by states and municipalities. And here is a T-bill. Now, a T-bill is issued by the U.S. Treasury with very short maturities of 4, 13, 26, and 52 weeks. Treasury notes and Treasury bonds have longer maturities than T-bills and also make periodic interest payments. I don't have a picture of a T-bill because they're not actually printed out on paper. Regular bonds are more popular and make up a much larger share of the bond market than do zeros. You can buy these bonds directly from the issuer or on the secondary market. A secondary market is a market where used or pre-owned assets are bought and sold. If you buy a bond directly from the issuer and hold it until maturity, neither the interest income or the redemption value of the bond will change in any way, irrespective of the direction of nominal interest rates. However, if you buy a bond on the secondary market, the price that you pay for that bond and its interest yield will be affected by two things: changes in nominal commercial interest rates throughout the rest of the economy and the time remaining until the bond matures. Let's see how a change in nominal commercial interest rates will affect the price of a conventional bond in secondary markets. Recall that when we were considering zero coupon bonds, we saw that there was an inverse relationship between the price of a bond and its interest yield. What you will see is that in secondary markets, the price of a regular bond, which pays a fixed rate at regular intervals, will also be inversely related to the interest rate. Let's take the following example. Suppose I bought a bond directly from Intel Corporation. Actually, I'd buy it through a broker, with a face value of $1,000, a coupon rate of 7%, and the terms of the bond were 10 years. That is, 10 years until the bond matures. That means that I'd pay Intel Corporation $1,000. In return, I'd receive their promise to pay me 7%, so that would be $70 a year for the next 10 years, and then they'd pay me my $1,000 back. But I don't have to hold that bond until it matures. At some point before it matures, I could sell it on the secondary market. Suppose, for example, that after holding this bond for 2 years, I'd want to sell it and get some cash. So, how much would bond investors be willing to pay for that bond? Let's suppose that in the 2-year period in which I was holding the bond, interest rates on newly issued bonds, those within the same risk category, rose to 10%. Well, I'd have a pretty difficult time selling my little paltry 7% bond. Who would want to pay for a 7% bond when they can get 10% on newly issued bonds? Answer, of course, no one. Unless, of course, I'd be willing to sell my bond at a discount. So you can see that if interest rates went up while I was holding my bond, the value of that bond on secondary markets would go down. Or suppose that interest rates fell to 3% while I was holding the bond. Now, that 7% yield would look pretty good. In fact, bond investors would line up and fall all over themselves trying to buy my bond. In fact, they'd be so eager to buy my bond, like this trader in the picture here on the floor of the Chicago Mercantile Exchange, that they'd pay a premium for it. That means that I'd be able to sell my bond for more than the $1,000 face value. When interest rates go down, bond prices go up. Okay, so we've dealt with the impact of changes in interest rates on the value of bonds in secondary markets. Now let's consider the effect that the time left until maturity will have on the bond's value. In order to see this more clearly, let's look at the formula for computing the value of a bond. The value of a bond is the sum of the present or discounted value of its stream of interest payments plus the present value of the principal repayment. This technical financial jargon is making this guy so frustrated that steam is coming out of his ears. But if you think of it, this formula for the value of a bond is pretty intuitive. In computing the present value of the stream of interest payments, use the formula for the present value of an annuity. In computing the present value for the principal repayment, just use the present value. For the discount rate, use the required rate of return, specifically the interest on newly issued bonds of similar risk categories. In this problem here, you will notice that the years until maturity were 8, and that is because I had held on to this 10-year bond for 2 years. Pause the video and check out this example to make sure that you can do this type of problem on a test. If interest yields on bonds similar to that Intel bond that I bought had risen to 10%, I could get only $840 for my $1,000 bond. But if interest rates fell to 5%, I could get $1,129. So now let's see how the variable years till maturity can affect the value of that bond on secondary markets. Suppose that rather than holding that Intel bond as in the previous example for 2 years, thereby having 8 years left until maturity, I held the bond for 6 years and had only 4 years left till maturity. Now, you should compute these answers yourself to confirm these numbers, but what you will find is that when interest rates rose to 10% while you were holding the bond, that the value of the bond fell only to $905 when the term to maturity was 4 years, rather than the $840 when the term to maturity was 8 years. But when interest rates fell to 5%, the value of the bond rose only to $1,071 rather than the $1,129, as in the case where the years till maturity was 8. A change in the time till maturity or term till maturity will pull the value of the bond in two directions. First, a shorter term to maturity will reduce the interest income that the bond will generate, thus reducing its value. But the shorter term to maturity will also reduce the degree by which the principal repayment is discounted, thus increasing the value of the bond. Now, an explanation of this phenomenon is right here. I would say that this is very important to know if you are going to become a professional bond trader. However, for personal finance, it would just be important to understand that the shorter amount of time left on the bond will reduce the range by which the value of the bond will be affected by the change in interest rates. A bond with a shorter term to maturity will be less volatile than a longer bond. If you were to buy a bond on the secondary market at a particular price, what would be your yield to maturity? That is, what would be the interest rate you would earn on that investment? You could compute this using the formula for the yield to maturity shown here. It looks complicated, but it's actually very simple arithmetic. Check out the sample problems here and get a little practice under your belt. Now, obviously, you will not be required to memorize this formula. As we've already seen, bonds are nominal assets because they are IOUs, but they're also a conservative as opposed to aggressive investment. They're conservative because they are low risk, but of course, they also have a low potential return. The return to bondholders is in the form of interest income and capital gains if sold before maturity in secondary markets. Keep in mind that you'll only make capital gains in secondary markets if interest rates go down while you're holding the bond. Bonds are low risk because bondholders are the first to be paid. Also, bondholders are creditors of the corporation that issued the bond, and the corporations therefore are required to pay their creditors unless, of course, they declare bankruptcy. There is no law that requires corporations to pay dividends to stockholders. Finally, bond prices don't fluctuate as much as stock prices do, so there's less chance of losing money. In fact, if the price of the bond goes down, you can just hold it to term. That way you get all your money back and you won't have to sell it at a loss. The optimal time to invest in bonds is at the very peak of an economic expansion. During the expansion, the price level will have risen, the cost of inflation block in the nominal interest rate stack will have gotten taller, and therefore nominal interest rates would be high. High nominal interest rates give us low bond prices, so here you could buy bonds at bargain basement prices and they'd be paying a high interest rate. As the economy contracts, the price level will fall, nominal interest rates will fall, bond prices will go up, and you could sell your bond, if you wish to do so, at a profit.